Welcome to the Advanced Investor Alliance podcast, where investors achieve their full potential through real and authentic content. This podcast is to inspire you to go beyond the mediocre results of the masses.
Oh, welcome to the Advanced Investor Alliance podcast. Yeah, I had to do a little pause there. Make sure you're paying attention. Make sure you listen. I'm really excited. Why I'm excited? Not because we're going to talk about money. I mean, you got to have money. It makes money. It makes more money with money. And a lot of people say that you have to have money, but not with the individual I'm sitting across from now, because he's going to bring in the knowledge of what you can do to do a no money down deal. Is that possible?
No money down? you may have gotten the wrong phone number here.
Yeah, he's a little conservative, but we'll break him down. Didn't you just do an acquisition? That was a no money down for yourself.
An acquisition for you
put money down
a little bit.
Okay,
I always, man. I'm conservative.
Well, let's stop the show here. No, I'm just playing. No, I'm really excited because we're going to convert Harrison today on how to do a no money down deal. That's going to be one of our subjects. So get ready. You might want to write that down, conservative banker. But the real question is, I'm excited because it's very rare to find a cool banker. Let me tell you how I met Harrison. So I went to this thing called CREC, which is like commercial real estate something. What is it called, Zach?
Commercial Real Estate Council.
Oh, by the way, that is our co-host, Zach Lorenzen. Hello.
Hello, everybody.
Welcome to the party. Anyway, so we were at this meeting. Zach was with me. We bumped into Harrison. He had a big smile, and I was like, hey. And he's a banker, and I'm an investor, always looking for great funding, and he has amazing terms. We're going to go into that. And the ultimate reason why I really like Harrison, he loves bicycling, right?
Oh, yeah.
And Harrison slapped me in the face because you did 100-miler.
Yeah. Hotter than hell, Wichita Falls.
And he's like, hey, man, you want to ride with me? I'm like, of course, for my 25-mile leg that I almost died on. And you've inspired me since then. I did a 66-miler.
Yeah.
Zach, I'm still waiting.
I'm ready.
When are you going to ride your bike, man?
The one you talked me into buying?
Yes,
Waiting on you.
Yes.
Waiting on you.
So I think it's important to build a relationship with your banker. I learned I had a great mentor banker many moons ago. And, he always said, Stephen, don't rely on me. You need to build relationships with other bankers because bankers do move. They move on. They have career aspirations. And I'm just fortunate to know you, Harrison, and I really appreciate you to be on the show. And forever, if you ever a banker or never being a banker, we're always going to be friends and ride bikes. So
I'm excited.
Let's get that out of the way. So Harrison's background is Ballerville. Didn't you have like your educational pedigrees and all that jazz? So you're I can't wait for you, ladies and gentlemen, for you to meet this guy. First of all, you work at a bank right now. What bank do you work at?
So I'm at a credit union. I'm at Weoki Federal Credit Union, which, I mean, the bankers and the credit union guys out there would get real mad if I didn't clarify that. So,
okay, so it's not a bank. It's a credit union.
Not technically a bank, but for what you need, sure.
So what is the animosity between you two?
Credit unions are kind of community organizations owned by their depositors. So when you've got an account in a credit union, you're a part owner. Banks are owned by entrepreneurs, private investors, that sort of thing. And so they're in a for-profit institution, which is great. We need those. Credit unions have a not for-profit status. It doesn't mean we don't make money. It just means it's not our primary goal.
Is that why your rates are different?
It can affect rates. We're mostly driven by the market, but it can affect it, especially if a certain loan product falls within our mission statement. And I think I'm going to take a moment here to clarify, I do work for a credit union. I do have to clarify any opinions here. They are mine. And I'm not like authorized to like be issuing our policy on this podcast.
Sure.
So they're just, if you hear anything, it's my opinion. If we talk terms, we talk rates, something like that, we're having a conversation. I'm not quoting anybody out there, promising anybody any money here. Right. I want to have that conversation with you, but that's not what's happening right here.
Yeah, and I agree with that. Let's just, first of all, rates are changing like wildfire. I saw a regular bank, not a credit union, email me and they said, pass this on. Now they're doing ARMs again. They're not getting locked in at all.
Mm-hmm.
I mean, this is a traditional bank. That's what they do is lock rates. That's how they make money. And they're so skittish and scared that they said, hey, these are only on an ARM for 3 years. I thought that was interesting.
Yeah.
We can talk about banking stuff. So let's get a little history about you. Where'd you come from? You had the coolest name on the planet, Barbarick, and then you have a Santiago is your middle name, and you are a third. Like trifecta, mother.
I keep it exciting and fresh all the time, man.
So let's get some history on your name. Where's it from? Like, where's Barbarick from?
So Croatian.
Okay.
If you were to ask me to speak Croatian, I'm not even sure that's a language. I'm like, I'm generationally American.
You
at
have
this
olive
point.
skin, though.
Cool.
Or you have Italian skin. It's not white, but you're you have olive
Slavic.
skin.
I mean, I guess you call me Slavic, but it's a couple hundred years ago at this point. So
Generational.
Yeah. I think a Barbaric would be your original pronciation.
Oh, sorry.
Although,
Correct me.
Yeah, well, no, because I don't go by that. Like,
Oh, you're Rick.
I'm American at this point.
That's funny. So, all right. So you're Croatian heritage.
Sure.
Sure. All right. Whatever. And so schooling, you are very passionate about banking. That's the reason why we're friends. We can have hours and hours of conversation about money, banking, borrowing, DSCR, right? All these
Love
weird
my ratios.
Did you start out that way? I mean, seriously, I'm going to be a banker, CEO one day. I'm going to own a bank. Like, how did you become a banker? Schooling? What? Tell me.
So I've always been a numbers nerd. Like my actual education, I have a degree in mathematics.
Cool.
And minor in finance. And so, what do you do with that? And there's several answers, and the route I chose was banking. And it was kind of like, figure it out as you go sort of thing. Like, first, how do I enjoy crunching numbers like a big old nerd, which I am. And so the start is there, and then it comes into like, where does ambition meet numbers? And so, banking, that's a great world for that.
I think it's a forever job too. I mean, I don't see it as scarcity. Money always happens. A lot of people. One stigmatism about bank that really bothers me is a lot of people are scared of bankers. They're scared because they wear suits, or they're scared that they're not going to get funded. And I'm like, I have to change this belief system that they can't function without you as an investor, you as a human. They make money on you, arbitrage. Do you know anything? Do you ever feel that way? I know credit unions are a little bit different, but have you ever thought of that? Does that ever come into fruition in your world? Like, people are intimidated, or like, oh, they're soft, mousy. Can I borrow money, Mr. Barbarick?
We get all kinds of things as far as people's tone. Now, of course, the more established, like you guys are yourselves, like, what to expect out of a banker conversation. But when it's your first deal, what people often see us as is we are the gatekeepers. We hold the keys, and we would love nothing more than to tell you no. But that's not the reality. Like, this is a mutual thing. Like, banks have to loan money out. I mean, at least most of us that we're kind of community organizations, we're loaning money out to survive, and you're borrowing it, part of your business model, to grow, to survive whatever it is. And so this is mutual. Now, sometimes my deal isn't good for you, and sometimes your deal isn't good for me, and we're all in business here. We get that, but I'm not in the, I don't need to see myself, and I don't need you to see me as some sort of like overlord or threatening presence, because in the end, bankers and investors, we got to work together.
You said when I very first met you, which is, I think, you said earlier, they say no. But I love the way you operate your business. And if I can remember correctly, I know you're going to say it better than I am. I'm going to give you a yes or a no within a couple of days. This is kind of your mantra. This is kind of your belief system. When someone's introduced, you kind of look at their financials and you give them a heads up. I think the biggest pain for real estate investors in general, are we going to get a yes or a no, and why? Do you have a disclaimer up front? I mean, do you know what I'm talking about?
Sure. Now, timetables always vary based on complexity, right? So like a couple of days for one deal might be a little longer for another, might even be less depending on who it is. But the reality is, investors, the worst thing you can do is take months to say no, right? Like, because you leave them in this state of limbo that is just frustrating, and it's limiting. And so my goal is to get to an answer as fast as I can. Now, that is also a mutual relationship. I cannot get to an answer if you do not give me the information I need to get that answer. You would not believe the number of times I've had a deal where somebody says, how quickly can we get this done? And I say, if everything goes well, X amount of time, it takes 4 times that amount because I have to email them 3 times a week asking for the same thing over and over again. So it's a mutual thing. I'm going to work really hard, but I need you to do that too.
Yeah, it's a two-way street.
Yeah.
Yeah, I think what I'm trying to get to the point was like a lot of bankers, their job is to build their book of business, try to get as many loans as possible within reason. But it's a numbers game because not everyone fills into your bucket of your qualifications.
Sure.
Where I have learned in the beginning of my career is, can you loan me yes or no, and what are you looking for? I just know with our relationship in the beginning, hey, let me get your financial statement. Let me take a look at it. What's your goals? What are you trying to do? And I will get with you a soft yes. Mm-hmm. And I just love that respect out of you. And I've sent a couple people your way, and it's the same thing. I'm sorry, I can't help you. You don't fit in this parameter. And we're going to get into a parameter or standards, I guess. I just admire that about you. And then the other thing that I admire about a banker, and I'm speaking this not to stroke Harrison, because I really don't need any money right now. But the reality is, I think a lot of investors don't understand your side of the fence. And one thing that really impressed me about you is that every Friday you sent me a flipping email. And I got nervous because every time you see an email from a banker, damn, they want something else. And I forgot how enema you are. I forgot that you really crawl under every rock and ask me for every piece of paper. And there was a misspelling. I had to do it right. But I just love the communication level between myself and you. Every Friday you give me this Friday update. Hey, I'm still waiting on the appraisal. Or, hey, I'm waiting on your LLC to be renewed. Hey, I'm waiting for this. Hey, I'm waiting for that. I'd love that. On your side, how could we make our job easier for you? What would be better way of communicating to you? What do you want when we first contact you? I got a $2 million deal going down. I can't order the appraisal because you got to do the appraisal. I know I got 20% ready to go. What would make your job easier? What would make your life fulfilled? Like, oh man, he's the best investor on the planet.
Transparency. That's number one. Like, you would not believe the number of times where somebody's asking me for millions of dollars and they don't want to provide basic information. I mean, if you as a person thought about, like, somebody comes to you and says, hey, can I have $1 million? And you ask them a couple of questions and they're like, whoa. You'd be like, come on, man. Like, it's $1 million. Can I ask a couple of questions? Can I get some documentation here? Like, you want to do your job right. So do I.
Are they doing it to hide something, or are they doing it because they're not prepared,
Or
don't
ignorant.
have tax returns, bookkeeping, simple stuff you think they would need?
It's all kinds of things. I mean, and I get it. Some people have been burned in the past, and so they're nervous.
Meaning that the guy took too long. The banker
took too long, or went down rabbit holes that the investor didn't like. Sometimes they are trying to hide something, and sometimes they're just private people. To which, like, that latter one, I take note on, because it's like, I get that you're a private person, but you've just asked me for money. Like, you're not a beggar, but you have asked me for money, and so I get to ask some questions.
You got to verify.
Yeah.
So your job, you said rabbit hole, and I noticed that I own several LLCs and different entities, and what your job as a banker, right? You're underwriting this individual before you bring it to the board of directors or whoever makes these final decisions. How deep do you go into their business? You try to get to their mindset, understanding they own these several LLCs and why, and you try to put this together as like a clue, like a game?
Yeah. So ultimately, the answer is always trying to figure out what direction are you going, and do I want to be on board? Mm-hmm. And so now, we all have hopes and dreams and ambitions, and one of the things that makes investors, entrepreneurs great is they have huge ambitions. Us bankers, we've got to be grounded. And so one of the places we really like to start that conversation is, where have you been? That doesn't mean to say that's where you're going to stay, but it is my starting point, because that's grounded. And so that's why I'm asking about the property you're purchasing. That's why I'm asking about your other investments, is what are you doing? Where have you been? Because that's a huge sign of where you're going.
So I don't know. How about a red flag? You're asking some guy or gal some questions, and they hem and haw. Like, what's a red flag?
First, refusal to provide information I know you have, right? Like, so like
like a tax return?
What tax returns, right? Like, we've got to file those. And so when you just say, I'm not giving you that, like, why not? I mean, maybe you've got legit reasons, but I'm a paranoid banker that's about to put a lot of money on the table. And so I kind of want to get my answers. And so I want to know that. Okay. And I know you have it.
This is awesome. Let's dial back.
Yeah.
This affects you, right? If you've loaned to someone and they default, that hurts your career.
Oh, yeah.
So I think a lot of investors need to understand the other side of the fence. How does it affect their game? We're selfish. I need money. I want to buy this asset, and I need you to loan me money, but I don't want to sign off on it. I want a non-recourse loan.
Mm-hmm. We don't see that side where, like you said, affects you, your career, your family, and everything that you're trying to build.
Yeah, I mean, I'm assuming you're a savvy banker. You want to go through life not ever in a default. Because I even asked you this question at one time somewhere when we were bike riding.
Sure.
Have you ever had a default, Harrison? No. Not yet.
Not
yet.
With me. And knock on whatever I've got to knock on to say that's not going to happen. But
right. I mean, we would never want it to happen. I think everybody should pay their bill. I mean, but things do happen, and I don't know. That's a bad subject because I'm fortunate that it hasn't happened. Zach. It hasn't happened to Zach.
So, one way of thinking about this, like when you're an investor and you're buying a property, let's use some easy numbers of like $100,000 rent house, wherever those are.
I wish.
So you're going to buy that, and your thought is, this is a $100,000 investment I'm putting in. Let's assume a real clean, easy deal. You put 20 in. 80 is what the bank or credit union loans you, and you're thinking, I'm taking $100,000 risk on this deal. Like, that is where I am, because my down payment plus if this loan goes bad or whatever, I owe them a lot of money. And so you're thinking that, but then you're also thinking of your ROI, right? Your return on investment, and you're thinking, okay, my 20 grand in, and if I can maybe do some value add or something, maybe even get another 20 grand, and I'm at 100% ROI there, and like I've got these opportunities to make really good money, and that's how you think I'm carrying the whole burden of this on me. The banker is also thinking something on the other side, but the banker's thinking, all right, we got a $100,000 deal, and I'm about to go in on $80,000, so I'm taking $80,000 of risk, and there's no 100% ROI on this thing for me, right? Like, I'm looking at, pick an interest rate,
7,
8%. Like, 8% is not 100%, right? Like, it's not. And so, and we can get into like fractional reserve banking and whatnot, but that's how I have to think about it, is like 80% of the risk, 7% of the return.
So you're ooh,
terms not binding.
So your mind, terms not binding. Silly. Oh gosh, this is going in the wrong direction. But the point is, like, you're thinking that they're going to default because the window of margin of error, 7% is my total gain.
I'm thinking I can't afford for them to default.
There you go. Great answer.
I cannot afford.
CEO in the making over there. I can't afford. That's a good answer.
I mean, when you're investing that much at that little return, you don't put money in a CD right now thinking I might not get this back, right? You put it in a CD because you will get it back, right? And so if I'm going to put something in at 6, 7, 8%, whatever it is, I have to know I'm getting it back. And that's why I'm going to ask questions. Lots of questions.
Well, you're really lucky, Mr. Banker, because you can borrow money at very little, low 1% interest rates and turn around and rent that money out. Also, Mr. Banker, you get to do this factor of 10. Someone deposits $100,000, that gives you $1 million to loan out.
Yeah, I mean, we do have.
So your risks are. I mean, you ultimately owe that money if something did happen.
Yes.
Unless you have a bailout, but that's another day. But the point is, I mean, you have so much power. You're getting 10 times.
I do have that at my disposal. And frankly, that is the only reason any of this makes sense.
That you can afford this suit that you have on right now that's so beautiful. So yeah, I mean, sure, we've got assets at our disposals, we've got risks at our disposal as well, and we can talk about how those matter and what they do right now. But yeah, I mean, but as the lender,
I'm not the one going out and securing those funds for borrowing. So what's on my shoulders is don't lose it. Right? Don't lose
So
that
there's some
money.
pressure there to perform. So on your side, now, some bankers that I've met that they have to have a certain level of loans that they write. Do you have that at the credit union level, or do you? I mean, because I guess that's why you were at the CREC, right? You were trying to find more investors to loan money to.
Yeah, I mean, I've got goals for the year. I mean, there's a thing called attrition in banking, right? Credit unioning, if you will. That it's, loans are getting paid off, they're getting paid down all the time. You have to replace them. And then ideally, all of us want to grow our business. And so we're doing that too. I personally have goals. I have goals that my institution sets for me, and I have goals that I set for myself. And yeah, I operate on that. Now, those goals are not go out and do whatever you
subprime loans.
Yeah, don't put garbage on the books. Like, that's not going to work for me.
It'll burn you.
It'll burn me. Yeah. No, I put on, however many dollars in loans, and one of those goes bad, I can kiss the next couple of years goodbye while I work that loan out.
Man, there's a lot of pressure there.
So what kind of deals or assets do you guys like to loan on? Are you looking for industrial, single tenant? Do you look for an anchor tenant, retail, single family, a package of single families, or do you do all of them? What do you favor, I should say?
Gotcha. I mean, we in particular are real big on real estate lending. And so, which is, what you're getting at there, but a lot of institutions go beyond just real estate, especially in the commercial space. My commercial division of my institution is real estate, and we are stabilized real estate. We are really competitive when it can be on our terms for that stabilized real estate, and we try and go after them. But we also don't like to take too much risk on that side, where we're not looking for these, speculative deals. We love stabilized. So if that's
speculative, meaning like a new development.
New development. I mean, real estate development speculative. Construction is speculative. If you're talking even like a lot of rehab deals, you buy a junker of a house and you're trying to like fix it up and get tenants in place. There's speculation there. You are assuming a rent rate that you have not established for that house. You are assuming a intact construction budget, and especially, we all know those rehab houses, there's something behind those walls in every one of them.
Sure.
And so there's that speculation there. Again, we can talk about what the word speculation means, and there's, different degrees of it, but generally, that's how we see it. And so for my institution, it's get the good stuff, but offer the best.
So when you say stabilized, you're talking about, say, a retail center with 3 or 4 tenants that have a 10, 15-year lease. You're more likely to loan on that because they're stabilized, they're going to be there, and the rents are going to be paid.
Yeah, when you've got a retail center and the tenants are in place, yeah. And I'm not going to speak necessarily the terms of those leases, because I get your different product types have different terms. But we want to see, have you achieved what you wanted to achieve at this point in time, or are you still reaching? And then especially, are you looking for somebody to loan on where you are or where you want to be? I'm the loan on where you are kind of guy.
Okay. So I know that you have this special matrix of stabilization. We've had multiple conversations on that. Let's give it an example.
Sure.
The Family Dollar deal that you loaned me money on.
Okay.
Okay. I hated that deal. The lease was dumb. It was 17 years. I was handcuffed to this lease. I called 3 attorneys. Can I get out of this lease? Is it possible? Because they were paying such a great square footage rate of $8 a square foot. No, $6 a square foot. It was still cash flowing, but I knew that this property could do 12. I knew if it was just white boxed, I could get 8 to 10. And you thought this later after we closed this deal, because I was crying and frustrated and trying to break this lease. When I ran this deal by you, you like this lease. Because...
Well, sure, yeah. And when you look at a deal, somebody like you as an investor, entrepreneur, is going to think, what is the most money I can make here?
Yes.
Right? The most...
Yes.
As a banker, the most money I can make...
is that percentage.
Is
that percentage. Yeah.
Damn.
I don't care if you quadruple... I do care, but it doesn't affect
I'll refinance it.
Yeah. You're going to make your huge amount of money... and I'm still going to make my percent, right? So, but when I see a stable lease, something that's long-term, a good paying tenant, somebody that's going to make sure I get my couple of percent, I love that, because you know what? You're not taking any crazy risks. You're not doing anything wild, and I get paid. Because when you do something wild, there's a reason. It's a risk-reward thing. You do something wild, you might make a lot more money. You might lose a tenant and end up with an empty space for a while. And now, where does my money come from?
Well said, Harrison. I can listen to you for hours, because you have this passion about real estate and education intertwined. It's weird that you like this so much. Most bankers don't think this way. Let's get into the stabilization thing. I wrote it down a long time ago. Can't remember what it is, Zach. Maybe you remember. Like when you refinance an apartment building with Fannie Mac, it's got to be 90 days at 90% occupied to get a refi with Fannie Mac or Fannie, whatever they are. In your case, you look at what's the criteria that you look at when you loan? It's not. What is it? Do you remember what I'm talking about?
Like for stabilized and underwriting. Yeah. So what I look at there is I'm thinking, me personally is, are there paying tenants in place, right?
So got to be occupied.
Occupied. Got to be occupied.
So it can't be vacant.
Yeah. And I mean, to me, what's the difference between the 5th month of rent paid and the 6th month of rent paid? Like if they are in there, they're a stable tenant, a reputable tenant. I'm
so let's clarify that. So if I'm buying this Family Dollar location and it's vacant, then you're not too keen on that investment.
Well, yeah, now I don't really know how much that building can bring in. I can know what market indicators say, but I don't really know. So you want
tangible data, a lease, greenbacks, a bank statement that shows that they deposited $3,000 a month.
Yep. I know what it's worth because somebody's paying it right now.
You silly banker. We do everything on ARV,
Sure.
after approved value.
I get that.
Our vision, performas. Okay, so the lease is in place, so it's got to be occupied. Got it. Next,
cash flowing, right?
Oh yeah, I had a problem with you on my refi.
Oh yeah, well, sure. So cash flowing, right? Because one of the things a lot of people like to think of, I hear this phrase thrown out, especially amongst people that are not very deep into real estate, which is they say, you get rents to pay for the mortgage, but the mortgage, especially in my world, my general terms are not going to escrow for taxes and insurance, and so okay,
commercial money,
yeah, and so we're talking. Okay, you can cover the mortgage. You still got to pay taxes and insurance, right? Also, HVAC systems don't last forever, right? Plumbing
CapEx
happens. CapEx.
Property taxes go up.
Yeah, all of that stuff happens. And so if I want to do business, I want to do it with good business people that make money. And so I don't look for it to break even. I look for it to make you money, because when it makes you money, you're going to want to keep that thing in place. You're going to want to take care of it because it's making you good money. Mm-hmm. And that's a great asset for me to loan on. When you've got an empty building that's worth $200,000 and is in distressed condition, that, I don't know where my money's coming from. I mean, we can talk about our hopes and dreams, but I don't know where my money's coming from. So if I'm going to offer a great product, I got to know.
Okay, and you do have a great product. We haven't got into terms or anything. So occupied, it's got to make money beyond the escrow. Okay, right?
Sure. Yeah.
Then what's the other?
So, I mean, if you want to talk about the make money, if people hear the debt service coverage ratio,
we heard that earlier today.
Okay, yeah. I won't go into that again. We look for that.
And it's 1.25?
We generally look at 1.25. I mean, every deal varies.
DSCR.
Yeah. You're going to have your own requirements when you underwrite a deal. We're going to be the same way, but that's a good starting rule there. Yeah.
Okay. So this aspect, I think, this middle ground of this cash flow, it's got to make money. What if that is in transition, but the entrepreneur, the borrower wants to borrow this money for this acquisition, but it's not cash flowing, but could they pledge something else, another property? Do you? And this will lead into why we had a conflict our last loan, our last refi. You're like, I can't give you that much cash out because you don't cash flow enough because my properties were under rented. Mm-hmm. I think whatever happened there, I can't remember. But you're like, you need to pledge more properties to get this much money back out. It was something weird like that. And I was like, golly, this guy, you're like running a cash flow analysis on a rental property and you don't do it by ARV, or you didn't even run it by the appraisal, you only run it. This is why you're on this radio show. I remember having this conversation with you. Every other bank on the planet just gives me what the appraisal is, cash out minus some, and I'm like, I only need 70%. You're like, it's not the 70%, Van Kallenberg, it's the cash flow ratio.
Sure.
Explain that shit to me.
Yeah, okay, so starters, every other bank is giving you that money, and every other bank's giving you a 15-year amortization, right? So so we're not every other bank. On it, I've got to know my multiple sources of repayment. Number one, do those properties, these things that I am tied to through a mortgage, do they make that money, that DSCR, that cash flow, to support my payments? What I don't want to do is rely on other properties that you have right now that I'm not tied to. You could sell those. You could leverage them up more or something like that. I don't have any control there. And
you're savvy.
So
Smart, man.
For those, I want if I'm married to a property, it's got to make sense, and I can't be married to other properties that I'm not, or tying into other properties that I don't have access to.
So you're lending based on that asset. You don't care about their portfolio, them as a person, credit score and stuff, or do you?
I do. It's got to make sense. Right? Like, so when loans, it's like my first look is, what does this property do? Does this investment make sense for me? The second step is going to be, how are you doing as a whole, right? Like, if you're a sinking ship with one good asset, I probably don't want to get on board there, right? Like, even if my asset's good. So I have fewer hard and fast rules when I look at you as an individual, but I do want to feel like this is not going downhill. And then, of course, I am looking at collateral, but I mean, who wants to think when they loan you money that their first strategy is take your property from you, right? Like, that's my last line of defense. And it's why I don't hinge my loan as much on that. I mean, yeah, I get an appraisal. I am limited on my LTV, but like it's the third thing I'm looking at, because I don't want to take your property from you. I want your property to make you money and stay with you and pay off eventually. That's what I want.
Gotcha. So what you're offering as a credit union, this thing called terms, or this thing, 30-year AM. Do you really believe that it's going to go 30 years?
No.
Yeah, so that's why it's just being attractive for you as a customer for me, because my payment's lower. But seasoning. Okay, I'm just running through all these scenarios. Your motive in how you're handling them.
So a 30-year amortization, which is a product that we have offered. Yeah, that I have to assume some of those will go 30, right? Most of them won't. I can easily speak to that. Most of them will not, but some of them will. And often, I don't want to be stuck with the one that is going to go 30 and be a problem the whole time. Or even worse, it's not ever going to get any principal pay downs. It's going to be just stuck.
So what terms, what's your balloon part?
Sure.
Is it 5 or 10, 20, 15?
We generally have ballooned at 15.
That's cool.
Yeah, it's just kind of let's not rehaggle over this thing every other year, charge new fees and everything.
Well, it's a long-term play. That's how you make all your money.
Yeah. I mean, I want those to stay with me. I mean, I'm loaning on good assets. I want them to stay with me. And the more tension points I put in there, the more likely they are to leave. So I don't want those tension points. I don't want
That's awesome.
renegotiating. I don't want new appraisals, because that is going to make you think, well, if I have to do all this again with you, I might go do it all again with somebody else.
So this is my philosophy, as I've been in this game for 20-something years. I use an acquisition bank. I season it, get my financials in order, my cash flow statement, my balance sheet, try to stabilize it for a year, 2 years, no more than 3 usually, and then I bring it to the 30-year AM.
Yeah.
So you're like in the step of financial wealth in my mind, because it's probably not as easy to do an acquisition. You prefer refinances overall, right? I mean, that's because someone else already took that main risk. Someone already vetted that process out. You're going to double check them with a new appraisal, see if it moved. And then now they should have equity in that position, and it's seasoned. So it's kind of a sweet spot. for
Sure.
credit unions, or is that just your bank in general? Is that credit unions in general, or
I think it's us in particular, although I won't deny anybody's anyone else's attempt. For us, because we see ourselves that way. Is I recognize a huge portion of my business relies on other institutions loaning investors money. Like, I get it.
It's a team.
And so on those institutions, they're going to make their money too, right? They're going to have probably higher rates. They're probably going to have higher fee structures. They're going to do that sort of thing so that they can get paid for their risk in the style that they do business. And then I am going to have to come in with fantastic terms in order to get that sweet product once it's done. And I
never think about it again.
Set it and forget it.
Yeah, I mean, I'm not processing a ton of loan advance.
Third big loan with you, I think, just for that reasoning. And I did it until I got to the credit union level. I had two other banks, a small acquisition bank that was expensive, that was motivated, and I just factored in the acquisition cost into the purchase of the property. Mm-hmm. Cool. So who's your type of customer that you work with on a regular basis now? Like, is it certain loan type, fee structure amount? Is it like, I was talking to Simmons Bank the other day. Mm-hmm. I don't know if you ever heard of Simmons?
Sure.
Okay. Yeah, I only do $20 million loans. I was like, well, I'm not your customer today. Today.
Yeah.
Maybe tomorrow. Give us some perspective of your ideal client.
So for me, again, we talked about the stabilized. Oklahoma City metro area is my geographic bounds, generally speaking. And so that's, of course, just going to be baked into it. As far as the property type, industrial, retail, rental, residential, I don't care. I mean, sure, I want to do big deals. I love doing big deals.
Because they're easier. They're the same amount of work, right?
They're maybe a little bit more work for a lot more reward. So so I like doing those when they're that stabilized. But there's honestly a part of me that also really, if we're just talking personal preference, love the new investor on the single family, the person that's just starting to build.
Really?
Oh yeah. I mean, it's sometimes stressful. It's sometimes, it can be really fun because somebody's
fun, stressful and fun.
I mean, adventure comes with tension. So
look at you quoting you. Adventure comes with tension. Damn, we're gonna write this down.
But it's also rewarding to know, like, some people, they're building their business with me. Some people, they're building their retirement. Like, right? I don't want to work till I'm 90. And
sure,
they don't want
to. Assets.
Yeah, exactly. And so these people don't either. And so I love the idea of like a real estate agent. I've worked with a few real estate agents that come to me and they're like, hey, I bought this property. It's my rental. I don't have a traditional 401k in my real estate agent brokerage. And so this is my 401k. And I'm like, let's do it. I love it.
You're such a great, diverse banker. I mean, we met at a commercial group, right?
Yeah.
I mean, usually those deals are millions and above, right?
Sure.
I mean, you're talking $100,000, $200,000 loan and getting someone started in their retirement, and you find satisfaction in that. Mm-hmm. The guy that was like $20 million deals, I mean, I looked at the guy, I just didn't know how to respond.
Whole different attitude.
Yeah, I was like,
it's crazy.
Okay, all right. I was like, okay. Can you pass me a muffin? I mean, this is like next.
Yeah. Well, and I mean, I'm sure there's efficiencies with different things, and I would hope that guy has somebody working right alongside him that's going to do that rent house, because those people need financing, right? The person buying a rent house today might be the one buying a $20 million property 10 years from now.
Dude, you are super savvy. I mean, we've been on this for 37 minutes, so we got to wrap it up. I got some cool questions. You got some questions coming up. But, it's interesting that I'm still with the same bank that wrote one of my very first loans. And I don't know why. I just feel loyal to them. And I feel that same way with you. It's like, I'm always going to give this banker a shot of what I have. And of course, your terms have been always incredible. And I don't think anyone could beat them. But it's not easy, right?
Yeah.
A lot of people, they may go to I wouldn't say a hard money bank, but they're pretty fast. And, you guys really dot all the T's and really ask the questions, and you have a whole accountability system behind you, right? You have a board of directors, or how does it work? Like, you get this portfolio done and this underwriting done, and then it has another layer of underwriting.
Yeah. So we I'm on the front end collecting all that information, and then once I get it, our underwriters do it. They are really good number crunchers. They're the ones that put everything down into a report that's readable, that tells whoever makes the decision, here's what you're looking at, and here's what you need to know.
I wish I was in that meeting. This guy Van Kellenberg, I wonder what the hell he's like.
So they put that together, and then they're not really an approval body themselves, right? They're just saying, like, here are our rules.
My opinions.
Yeah. And they'll do things like, they calculate, our policy says X% loan to value. I can't send this on with it being more than that. So they're not putting restrictions. They're just following the rules that others have put in place. But then once I get that final product, that report on how everything's doing, that's when I take it to the approval body, which can vary. It varies by institution, and it varies depending on loan size in my own institution, on who's signing off on it. And so, but I'm taking it there, and they're making that final decision, And
you're selling this person too, right? You're telling them why you brought this loan to them. That you're like the liaison between the investor and the final approval, right?
Yeah. I'm a liaison's a good word. Selling may not be the most accurate because right. I mean, the point is, I want to give an honest presentation, right? And so I want to give we're getting in on this deal. I don't want to sell them, junk, right? So
it's your job, your life.
It's my life, and so I'm going to tell them exactly what they're getting themselves into. And what I hope is that, to get there, I have facilitated good conversations and good underwriting that makes them confident in what I've brought to them. But that's kind of my approach there, is I take it to them.
All right. Speaking of underwriting, have you ever driven by a property, or do you drive by all the properties?
I drive by every single property I loan on.
That's awesome. It's just interesting. I just, there's another banker, a small country bank. They drive up and they take you out and they drive the asset with you. I was weird. Like, hey, we want to get together. I'm like, okay. And that was the first time that I ever knew that. And then I know the skilled bankers that really care about their portfolio and really care about what they're doing want to verify that this is exactly what we're dealing with.
Oh, yeah. I want to know if there's a hole in the roof, right? Like, I want to see...
if there's customers in the building.
Yeah. I want to see that the business is operational. And it's not uncommon, like, if I'm loaning on retail, like, if it's a store there... yeah, sure, go inside. It's public space, maybe even buy something, help it out, But I want to lay eyes on, but at minimum, I'm going to drive by the place. And if I'm looking at like a rental portfolio of 50 houses, I'm not going to be like, let's go house to house inside, knock on the tenant's door. That's ridiculous. Yeah. But like, I want to lay some kind of eyes on everything.
See what they're like.
I mean, for the most part, you probably don't want to buy a lot of houses unless you have a really close, trusted team that's doing this for you. You're not going to buy a ton of houses without ever seeing them.
Sure.
You're going to want to check them out.
Yep.
Yeah. So what advice would you give to help a young transitioning? They got 30, 50 houses. They're done with single family, and they want to buy a industrial park or something to that effect, or trade up, as some would say. What advice would you give them, or have you ever seen that happen, and what would you say to that person?
Sure. First, I would say is know your numbers. Not just the numbers on what that asset's going to do. Know the numbers that you have on the books right now, right? Your banker doesn't know your world the same way you do. What they know of your world is through your tax returns. Mm-hmm. And so you want to know your tax returns too. Know what's in there. I get a lot of people are legally doing their taxes in a way that is beneficial to them, but that also sometimes involves things that bankers just
can't loan on.
They can't loan on, or they need clarification. Know your numbers and know what's in there, so when your banker says, hey, you got this big old number buried back there, you can answer that. Like, that's really helpful for them, because otherwise, if you can't tell me what a number is, I'm assuming that it's bad, right? Like, I have to assume.
Good point.
That's a good thing. And then when you're moving into the commercial space, your leases are very different, right? Like your triple net leases, how things are collected, who you're dealing with, right? When you're dealing with a residential tenant, you're dealing with likely somebody that
doesn't know.
They don't know, and their financial resources are not the same as a $1 billion organization, right? That might be leasing that space from you. And so when you're going toe-to-toe with big tenants, you need to know what you're doing. And so because
it's awesome.
Does having a mentor or a group that has done multiple deals and is walking you through the process and helping you, does that help at all for the new guy? Do you take any credit to that, or is it
like a CREC, connecting with other like-minded people to assist in this? Because like when I did the Family Dollar, I had no idea how to handle. They have an army of attorneys.
Sure. So what matters to me is where, not just you saying you've got your counsel, but how that counsel's coming through and how you're listening
like your
to
attorney.
It. Sure. So like what I'm cool with hearing, I love hearing like, hey, my attorney and I have been looking at this lease together. Like that's a good sign, right? Like I like that you guys are paying attention.
And you're paying $300 an hour.
Yeah. So I like hearing that. To just say like, hey, my buddy does real estate and we talk about it sometimes, like there's not a lot of substance to that. And so to me, the substance of that mentorship, right? Like you can go to CREC, which I love that organization, but if the substance of your mentorship through CRC is going to the meetings, eating lunch and hearing a presentation about a cool project in town, that's not good enough.
Yeah, gotcha.
Yeah, smart. Good point, Zach, to bring that up. All right, so know your numbers, right? And have a great team or a council assembly of people, an army behind you. You can't do this business on your own at the commercial level.
Sure.
And maintenance is different. Insurance is different.
Yep.
Escrow is different. Cash is different.
Leases
cash flow is different. And the leases are important. This lease, I ran into a ton of lease issues over time. Of course, Family Dollar has set the standard for me. I can't believe that they drafted this amazing document that I can't get out. Mm-hmm. I can default, but they can't default. I'm like, wow, we can have a whole podcast on it.
I think it was a stabilized asset though.
Yeah, I know. Yeah, Harrison loves that asset. And I'm like, I'm beating him up right now. I'm like, Liz, did we get the taxes? I know we paid the taxes. Is it triple net lease? We're like digging into it right now. So we're ready to, how far behind? Because we acquired that asset in the middle of the year. Mm-hmm. So,
well, and it just like on a like a investor scale, like right when you're buying your first rental property and you're out there, you feel like you're going to all these bankers and it's like I need you, and then eventually you have a ton of units, and then you're like you need me kind of thing. And those tenants in those commercial properties, they can be the same way, right? Like this is not your mom and pop yoga studio here that is like, I need you to operate. Like if we're talking like a major corporation, it's like everyone and their dog wants to rent to them. So they do get to set some of the terms. You got to protect yourself, don't get me wrong, but like,
so
they've got
an
huge
anchor
leverage.
tenant looking for the best ideal place with the best terms.
Yeah.
They've got
so you have the
clout
clout
move into, so they can
so like franchises. Do you guys do SBA loans over there for business owners?
I don't know that we do a lot of them.
Okay, I was just curious. I have a friend that has a new franchise that he acquired, and just listening to him find a place, getting an LOI letter on a location, and following this franchise model. I would assume it would be a slam dunk for a bank because they're a proven track record. It's like, opening a Subway, it should be a win, or you open up a Chick-fil-A, it should be a win. It should be easy to get money for those franchises. And that's what struck a chord when you said, hey, if there's a really good tenant that has credibility, right? A credit, they can kind of predict their terms. Oh, they're used to paying. Maybe I need to rethink my Family Dollar because it is a credit tenant, and that's why they're getting a discount. But I'm really pissed about it.
Sure. I mean, because for them, their thoughts are and
you
not
need
to
me.
Yeah, not to pick on yoga studios. They have their place and are important. But like, right,
I didn't know you like yoga.
Yeah, I'm good with it. Yeah. Okay. So a mom and pop yoga studio, like if you look at them and you're just like, I don't really know who you are. I might do some basic underwriting to get you in here. But if you end up having a pandemic happen or something, you might lose your business and be in trouble.
Interesting.
Whereas Family Dollar, you're thinking like, these guys, we know them, right? Like they've been around for a while. I have confidence.
Yeah. Dude, you're so good because we have an investor friend that's a friend of ours. It's like, it's got to be COVID proof. I'm like, well, this dude, like he just thinks this way. He's very risk reverse. And it's like, I'm not going to be in any business that's going to be affected by COVID.
Mm-hmm. I think that's a big eye opener for everybody, banks and investors.
Yeah,
alike.
Well said.
Frankly, our economy was not COVID proof, and you can't really look at everything like that's going to happen every year, right? That's not realistic.
Right. But it may happen again.
And other things will happen, right? Mm-hmm. We don't know what it'll be next, but something's going to happen, and the more quality of a tenant you have, the more they're going to be able to weather that thing.
So the next thing is the financial meltdown? No,
I'm
you're
not allowed to
over
disclose
here.
that.
You're gonna be working over here at the Family Dollar. No, I was just playing. So Harrison, it's been a pleasure, man. Dude, I'm stoked that you came and your bank said okay. You know, I was nervous when you were like, I got to talk to your boss or whoever, the board of directors, and see if you could speak. Thank God we didn't mention that bank at all. We didn't mention your bank.
Did we?
Yeah,
Okay.
he did.
Yeah.
We did.
Yeah.
Damn.
That's all right, though. Nothing binding here.
No. So, anything else that you think that needs to be heard? You know, a young guy, a young gal that's really new. Did we forget anything? We got the stabilization going. You don't it's got to be occupied. It's got to be cash flow. And if you want to refinance with you, it's got to be cash flowing more than you think it is. And it's not based on ARV or what the appraised value is. There's a secret ratio in your little closet that you represent. You're still rocking 1.25 DSCR. So
Subject to approval.
Subject to approval.
That all sounds strict and stringent, but your product.
Yeah, the cash flow, that Family Dollar deal,
is worth all the.
That's what we try to do.
And honestly, the terms that I received back then, of course, the interest rate's way lower than it is today, and the terms makes that property that I paid full retail in my mind. It wasn't a distressed property. I paid what their retail price was. The appraisal came in at, I don't remember, 1.3 million, somewhere. It was real close to what the loan, 1.2 is what I had it under contract. I mean, it was very, there was no like 98, 70% value.
cash coming back.
Yeah.
No, I had to put 20% down.
Sure.
There was, well, of course, Harrison would not let me not have it, but I'm just saying.
So,
But it worked. It was attractive. The terms that I received, 30-year AM, it cash flows very healthily and it works.
right. Yeah. We keep talking about like my strict requirements, right? And that's fine. Because if I'm going to ask for the best, right, I need to give the best. And that's why like you follow up all these conversations with like, it's like, yeah, it's kind of painful. Like I'm asking for this, that, and the other. I want all your tax returns. I want 20% or whatever. And then I come in and say, but to my best knowledge, your loan with me will get you the best cash flow in town. And that's a pretty solid response to
Confidence.
Everything I
It
ask
makes it
for.
worth all
Right.
the work. Going
You're a
to get it.
superhero. All right. Well, man, it's been a pleasure. Can't wait for you to be back on the radio. Not radio show, podcast, same thing.
Thanks for having me.
Thanks for listening to the AIA podcast. Stay motivated by listening to our other powerful episodes at AdvancedInvestorAlliance.com.